Welcome. About this sort of time of year, we begin to talk about volatility, and we've seen recent evidence of it ticking up a little bit. The big question is though, how you go about trading this and using this as an opportunity to look at other markets as well. Well, joining us now is one of our regular guests here on IGTV. It's Ron William from RW Advisory. Ron, welcome. Good to catch up with you again. As I said, this is an opportunity perhaps maybe to look at the trading environment around this increase in volatility. What are you going to tell clients about your thoughts on how to go about this as a trading plan?
Well, great to be back in discussion, especially at this midway part of the year into the seasonal negative cycle. And the three guidance points I would kick off with is, one, trade what you see. If the markets are up, continue to follow that friendly trend, but manage and optimize the risk, number two. And number three, look for potential smart diversification. So that would include some of the safe haven plays and maybe some of the volatility contracts in case we get some of that traditional negative seasonality in September and October. Now, what we can see here in this opening slide is the global ranking model. And that just highlights some of the existing trends that have been strong year to date, specifically the Eastern markets, which had the first in, first out advantage from the pandemic, but also they had strong trends already. That includes India, Japan. At one point it was China, but no more. And then, of course, we've got the US markets there in blue, strong at record highs, but flatlining literally as we speak. And then some of the economic sensitive markets, oil and copper, falling from grace, showing that there's been a little bit of a peak in growth and transition in inflation. And lastly, safe haven plays like gold, now starting to slowly, steadily ebb up higher.
Remind us how this the boom bust cycle develops.
Yes, so this is a primary driving force of our work here at RWA, and it's this idea that trends do exist and they're your strongest and highest probability strategy, but they do lose momentum and they do turn, and that is part of the market cycle, which has more of a asymmetric shape in traditional markets, and that is what creates the boom bust cycle. So risk on the way up, risk off in the transition between W, X, and Y, three-stage process, not an overnight move. And then finally, risk aversion when we go into the down part of the asymmetric shape. Now, what's made this business cycle so different than any other is, of course, the pandemic of 2020. We had such a sharp panic sell on the way down that we had exactly the mirror image on the way up. We had panic buying led by FOMO, central bank liquidity. And so that created not a V-shaped recovery, but a K-shaped recovery where we had extreme polarity, winners and losers. And so that created a whole new twist in this roadmap where we did see new record highs in certain markets like US equities and some of the sectors that benefited, tech, for example, from the pandemic, and then others that still failed to actually to outperform and gave more of a weak signal up until now. So right now, the view is still that we're in this Minsky risk late cycle play. And so we're continuing to watch this as a framework of what's yet to come.
How much of this is dependent on what's happening with the growth outlook? Because I referenced this because this time last year, of course, we were in not the eye of the COVID storm because we'd sort of passed it, I think, to some degree. So we're looking at growth numbers that are coming through at the moment that are very, very good because they're compared to such dire numbers this time last year. How much of what you're looking at here depends on a shrinkage in growth and a relative worsening of economic data?
We're always on the watch on market indicators, including the economic sentiment. And the best to look at is literally where investors are putting their money where their mouth is and actually voting with their feet. And this is a survey here from Bank of America where they actually quiz top fund managers around the world about their expectations, in particular on the US economy. And we can see a collapse in sentiment post-March, and it's not just based on these figures. Look at the Citibank surprise index to new lows for the first time in about a year, and some of the leading investment banks also revising their year-end views on the US equity market in particular, and just economy figures in general. And let's remember, we've had a record-breaking economic recovery from a pandemic shock. We've also had transitory inflation, which has helped, during the consumer-led expansion phase, but that now looks transitory if we see some of the commodity markets unwind, oil and copper being an example. And then, of course, most recently, the very reason why we got into the crash in the first place, the pandemic, we now have the new variant, which is starting to force a reevaluation of some of those risk indicators as we go into this negative seasonality pattern of this year.
Of course, the other thing one would say, if you're looking at this in the context of the recent gains we've seen for all the major equity markets around the world, is that even as we speak, we've only just seen a very, very small pullback. What catalysts are you looking for, which will give you an indication that we are about to see a trend reversal?
Yes, so it really is important to trade what you see, and that's been the toughest discipline to follow in this cycle, because we've seen lots of divergences in this record-breaking recovery, but we have to continue to trust the trend until signs of a real reversal emerge. I was early to call a market top late last year, still hold the view, but I have since been very keen to look for strong market reversals and not false signals or any kind of whipsaw action. So here on the S&P 500, which is a great leading indicator to the greed trade that we've all been benefiting from, the line in the sand is the 50-day moving average. We've had 5 and I think 6 and 7 recent buy on the dip opportunities. It's been a closely watched trend average. If you can see just there how well it's held as support. If that trend average, which is roughly around 4,400 right now, reverses to the downside, so the price actually crosses back below that average and the average then follows, that will be probably the best and most conservative bearish reversal signal for a well weighted and healthy correction. And then what's interesting on the chart inserts, figure 2 and 3, these are fear and greed indicators. So greed, the option market based on put call ratio at extremes, and we all know in terms of how popular option contracts have been in terms of making people money to a degree. And then the lower chart, cash, which is a great measure of the complacency of investor sentiment, that's at extremes. So cash is trash currently, but it's at extremes. And whenever we're at these record extremes, they do suggest contrarian points, not least in the chart on the right, which is a measure of the behavioral bias, FOMO, a real bias of our time, fear of missing out, a combination of loss aversion and overconfidence. That is also at record extremes if you look at the number of times that people have searched for the term on Google. So all of this is suggesting late cycle stuff, but remember, trade what you see and only factor in the downside risk on the S&P 500 if and when we get a break below that line in the sand, the 50-day average at 4,400.
And what else is it you look at in the markets that might give an indication that we are at or very near the top of this cycle that we've been witnessing?
Yes, so certainly an inflection point of price and time setup. On that last slide, I also had a proprietary market timing indicator, specifically DeMark, which also had a red 13 signal, but that's one to, again, wait for the reversal down below the average as a confirmed timing setup. On the following slide, the market anomalies, I think, add to the picture. A lot of people that are just roaring bulls, and they would really kind of taboo this discussion that we're having about asymmetric risks in the second half of this year. They're thinking central bank liquidity. They're thinking about how great the trend has been. But let's not forget one important market anomaly, which gets me concerned late at night, is that we haven't had a 5% not a 10% or 20%, a 5%, which is a minimal healthy move in any market cycle. We haven't seen more than a 5% correction in a year since the pandemic. Now, there's a whole bunch of important insights from that. One, that's a rare anomaly, and so that just increases the chances of an asymmetric risk. Two, it creates a real strong behavioral conditioning in the market, because we only think that the market goes up in a straight line up, especially the first-time traders and investors post-pandemic that have really had a good experience in this cycle. They haven't experienced the pandemic crash with live money. They haven't experienced the global financial crisis or any other prior shakeout to know how to manage that type of vol. And the other thing is, they continue to buy the dip, buy the dip, buy the dip. In a bull market, everyone's smart. Most people make money. But we really do need to be prudent as the future expectations of past results change. And you can just see there on the right, the only time that we've had a 20% gain in the first 8 months of the year has been, if we backtest this, top right chart, has only been a few times in history, and that's given anything from a extend in an unusual situation, further gains to the upside of 21%, which I think is very different to the environment we're in, but much worse, a 32% risk in the remaining part of the year, and the average is 2.1% if you wanted to just focus on the numbers and crunch them. That's just a kind of a reference point just to have as a yardstick. But I would say, remember that we haven't had a 5% correction in a very long time, and the issues that will bring with it. Although we haven't seen that move in the markets, we have had speculative moves like the crash in Bitcoin and the unwinding in tech and meme stocks. Potentially the next shoe to drop is the very market that most people like to talk about and trade.
Let's now talk about, in fact, what we've spoken about before in previous interviews, and that is this cycle, this move up, this move down. How are you viewing that chart now? If we could ask you to revisit what you've spoken about before.
Yeah, so a big part of what we do at RWA is, global, multi-asset, but within a top-down framework, and that's using quantitative and qualitative measures. And here's an example of the blend of the two, where we're crunching the data of the last 100 years of price performance in the US equity market and looking for patterns, seasonal patterns. And so this is the seasonal pattern output of that test, showing us that traditionally we get a late cycle top for the year. In late August, early September. The worst of the move or the drawdown is in the month of September, not October, which most people remember as the market vol month, not because it's the biggest mover, but because, as you can see there, it has the true lower low in the market, which marks the anniversary bottom. So in short, expect a traditional negative seasonality in this month of September that we're already in. The strongest move, at least statistically, to happen then, especially given that we haven't had a 5% or more correction in a very long time, and lots of sentiment indicators are extreme. And if we get certain trend reversal signals like a move below the 50-day average or any other metric that people will look at, and watch out for that pattern taking place. Now, here's a quick point here. This is a historical rhyme, but not an exact pattern repetition. So this is just an idea of how the market can dance during the next few months. But we need to actually watch the real price action to see how it will act live on the screens.
Okay, let's wrap this up and go back to what we started about talking about, and that is the volatility. What do you say to people about how to trade this volatility opportunity?
Yes, so always know that volatility is a changing series. Mean reversion in nature, and high vol leads to low vol and vice versa. And for a long time now, Jeremy, you and I have been talking about this technical compression pattern in volatility, particularly the VIX, which is a futures pricing of the S&P 500 vol. And we can see here on the chart that yet again, we're in another breakout pattern, which on face value is low vol. But the flip side to that action is the reaction to the upside, a spike in vol about above 20% or so. We could easily shift from 20% to 40%, which is the October peak level from last year. And I highlight October as a seasonal peak in volatility, just in the coming months ahead. And then also, don't just look at the VIX as you're reading on vol. Look at the internal signals of vol. And many option market specialists will tell us that there is increased demand in volatility protection. So if you look at implied vol versus real vol, there is a rare signal right now where that ratio is getting more expensive as people start to price in lower performance in the next 6 to 12 months, or even year end, versus the phenomenal run that we've had so far. And then just there on the top right, insert B, a cycle proprietary model that highlights not just high vol in September, October, but also November, December, which may taboo the idea of a Santa Claus rally this year. We may actually have a series of lightning strikes as we close this year of 2021 into the new year of 2022. So these are what the probabilistic signs are showing now. Continue to trade what you see, but remember, make sure that you're optimizing your risk, potentially using smart diversification, and look for some of those hedges just in case as we enter this negative seasonality pattern of the year.
Yep. Okay, look, Ron, we'll leave it there, but thanks for joining us for this look at trading volatility. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.